Salam guys, if you look at the financials of GM stock, for instance, you're going to notice something pretty intriguing. GM has a PE ratio of around 4.8. The lower the PE ratio, the cheaper the stock is. The industry average currently is around 15 times earnings, and the market average is 13 times earnings. GM is trading at dirt cheap prices right now. Additionally, GM has a dividend yield of 6.92%, whereas the industry average currently is around 4%. So it has a higher dividend yield than the industry average. GM has a price to book ratio of 0.7. This means that at its current price of around $22, GM is trading for less than what you would get if you sold the company for its parts. That's pretty remarkable. Now, the ratios I mentioned may give you the impression that GM is a compelling investment opportunity. However, in my view, these ratios that I just mentioned that seem attractive simply make GM a textbook value trap that I want to warn you against falling into. Value traps are basically stocks that trade at low multiples, low valuation multiples, so they attract investors who think that they're getting a good value for the money that they're paying, when in fact these stocks are in all likelihood going to continue to trade at these low multiples for an extended period of time and may even go lower in price. So what I want to do in this video is give you 4 questions that you can ask about any stock before you invest to help you identify whether the stock you're considering is offering a truly compelling value proposition or it's a trap. The first question I want you to ask is, what has been the overall trend for this company? Fundamentally, it's important to remember that when you're looking at the prices of stocks, you are not looking at a snapshot of the present or the past. Rather, you're looking at a distillation of investor expectations for where this stock is going. The multiples that we looked at for GM stock, for example, tell us information about GM's present and they tell us information about its past, but they tell us precious little with regards to GM's future. To understand a stock's future, it's important for us to look at the recent trends that the company has been on. So for example, if we look at the most recent quarterly report of GM, which was the report for Q4 of 2019, and we compare it with Q4 of 2018, we notice the following. Revenue is down around 20%, net income is down around 109%, net profit margin is down 110%. Operating income is down 136%. The net change in cash is down 98%. So basically everything on that right-hand column is all in the red and substantially so. If we look at GM's debt-to-equity ratio, for example, again, the trend is not in the investor's favor. The debt-to-equity ratio continues to climb. The amount of debt that they have compared with the equity that they have continues to climb. So we have debt rising in relation to equity with no corresponding rise in GM's earnings. In fact, we're seeing a decline in GM's earnings. And frankly, this combination of increasing debt, decreasing earnings is a recipe for disaster. So investors looking at this are rather unsettled, and rightly so. And this is reflecting itself in these low multiples that we saw earlier. So the multiples that gave us the impression that GM was perhaps a compelling value proposition are now being placed in context when we look at the trend of GM. And now it appears that, in fact, GM is not so compelling of a value proposition. The second question that is important to ask when identifying value traps is to ask, what is the general trend of the industry in which the company belongs to? Some of you may be familiar with the story of Blockbuster. For those who aren't familiar, Blockbuster was the lead video rental company in the United States for around 20 years. It was started in 1985 and it reached its peak in November of 2004. At its peak, Blockbuster had 9,000 stores globally. It made $5.9 billion. It had 60,000 employees. And yet, at its peak, in terms of revenue, it was only trading for $9 a share. Compared with 2 years earlier, it was trading for $30 a share, even though it had less revenue. So many investors looked at that price of $9 per share and said to themselves, hey, let me pick up some Blockbuster stock while it's trading at a discount. Eventually it's going to correct. It should correct to at least $30 a share because after all, it was trading for $30 a share when it had less revenue and was a smaller company 2 years ago. But investors who thought this way were ignoring the overall trend in the industry in which Blockbuster was in. People started less and less going to physical stores to rent out movies. There were other options that were popping up for people to use that were a lot more convenient than the customer actually having to go to the physical store, renting out a movie, and then coming back days later to return that movie. What appeared to be a compelling value proposition for some was in fact a value trap. Today, the once famous video rental company has shrunk to a single store in a small town in Oregon. If you bought shares in Blockbuster in November of 2004, you weren't getting a good deal at all. What you were doing was analogous to buying tickets for a trip on a ship that was sinking. Keep in mind here, I'm not implying that investing in Blockbuster would have been halal. I'm just trying to illustrate what a value trap looks like. And going back to our example of GM, I would contend that for the vast majority of internal combustion engine automobile manufacturers, the writing is on the wall for them as well. The third thing I want you to ask in order to identify value traps is, what are the insiders doing? No one understands the future prospects of a company better than the people who actually work at that company. They have first-hand experience with the company's customers. They can see trends before anyone else. So the behavior of insiders is very informative when you're trying to ascertain the future prospects for a particular company. If you look at the breakdown of GM ownership, you see that only 0.2% is owned by individual insiders. Now, if it was the case that GM was truly vastly undervalued and it was a great deal to buy GM stock at its current price, I would expect to see more activity from insiders in GM as it relates to buying up GM stock, but I'm not seeing any of that. If you compare the ownership breakdown of GM with the ownership breakdown of a company like Tesla, which I'm very bullish on, you can see that individual insiders for Tesla own 20.7% of that company. And this leads me to believe that the people that work inside the company actually believe that currently it is either fairly valued or undervalued in light of its future prospects. The fourth question that I want you to ask when attempting to identify value traps is whether or not there is a particular catalyst that you can see that will take the price of the stock from being undervalued to fairly valued. Now, this catalyst could come in the form of a new product release, or the company posting profits for the first time, or results that exceed expectations in some way. So if you think that the stock of a particular company is undervalued and it's actually a compelling value proposition, then you should be able to identify a catalyst, a milestone, wherein the price is going to go from being undervalued to fairly valued. If no such milestone or catalyst looms on the horizon, then I would suggest that there's a high likelihood that you're looking at a value trap that you should probably stay away from. Now, if you're looking for a place to buy stocks, I've been recommending M1 Finance because I feel like their service is tailored for long-term investing and it encourages the right investing habits. If you'd like to try M1 Finance out, it's a completely free service. And if you do decide on trying it out and you'd like to support the channel, please use the link in the description below. If you need halal funding and you live in the United States, go to fundmebff.com. Alternatively, if you're an investor and you earn more than $200,000 annually and you're looking for a halal investment to make that pays out monthly dividends and has had a risk-adjusted return that was superior to the major asset classes in the last 3 years, basically since the inception of the fund, then go to fundmebff.com and apply to become an investor. Until next time, make sure to take care of yourself. Assalamu alaikum and peace be upon you all.